Okay, welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Leslie Fourton. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that out of the way, I'll transfer control to you, Leslie, and welcome you onto the roundtable. I know I've known Leslie for a long time, and Leslie just started up the Technical Analysis Trading Group a few weeks ago, so that's kind of exciting. And we're happy to have you on the roundtable for the first time and share some of your extensive knowledge and expertise in technical analysis. So welcome.
Hey, well, it's really great to be here, Tom. Hi, everybody. I'm glad to be here, and I'm always excited to talk about technical analysis. I could talk about it for hours and hours and days, but we'll keep it down to an hour today, and it'll be a good start. There's so much to talk about. I mean, if we want to talk about whether it's Gann theory, from William Delbert Gann, one of the greatest traders of all time, made a fortune trading gold and shorting the stock market in the great crash in New York in the back in the early part of the last century. And he did so well that he even hired the first female pilot so he could carry all of his gold from New York to into the Bahamas, into the Caribbean. But nevertheless, so there's Elliott wave, which I'm a big fan of, and also Fibonacci analysis. But today I want to get started with Elliott wave, with the basics, because I'm going to assume that that people are starting out for this, and which I think is a reasonable assumption. So I'm going to pick a writer by the name of John Murphy to go to his site. I'll send you the link. You can go to it. We're going to go through this kind of quickly, this part of it. And it's from stockcharts.com, which is free. And
Leslie, you need to be sharing your screen?
Oh, yes. Oh, yeah. I'm sorry.
That might help. No problem.
Yeah. That's great. Funny. Is it shared now?
Not yet.
Oh, do I need to do it? Or do you do it?
Yes. Well, I've given you the presenter role, so you need to share your screen now in the WebEx Event
okay.
Center.
Oh, great. Let's see. Where is that now? I just see roundtable, in gray. So
you have on your taskbar a little green and blue, or greenish, whitish, bluish ball for the WebEx Event Center?
I don't actually, unless it's behind the one I have. Let's see if I can move it. No, I don't. Let's see.
Try going Control-Alt-D like desktop. There's a keyboard shortcut that might work. Yep, that did it.
Is that it?
It's
great.
Loading. Yep, I see an ocean with some palm trees. Yep.
That's it.
Okay, we're good to go.
Now you see the three rules, right?
I do.
Great. So to start out with Elliott wave, I mean, why are we doing this? We're doing this because we're essentially trying to, and also doing, creating synergy, some sort of synergy within the market amongst all the chaos. So we want greater levels of synergy, and we're because there is so much synergy in the universe per se. I mean, just a minor footnote here, that is to say there's synergy from buildings that you look at, there's synergy from great architecture, there's synergy from sounds, from great music you listen to, what's pleasing to the ear. These are all forms of synergy, and there are similar forms of that synergy in the market amongst the chaos. And that's what really technical analysis is, a lot of it is all about. creating synergy amongst the chaos. So why, and then amongst the synergy, what are we looking for? We're looking for areas of confluence. And the reason why we're looking for areas of confluence is because we're looking for pivot points. And the reason why we're looking for pivot points is because we're looking for pullbacks in the market and reversals. Because even if, if you're a typical trader, you don't trade options and you're a directional trader, you're always looking for pullbacks. And this is a way to look for, pullbacks because if the market's rallying, you're looking for a pullback to get in because you don't want to pay the top price. If you're looking to short, you're looking for a pullback to go short because you don't want to short it at the lowest level because you want the greater price then too. So you're always looking for reversals. And even I would argue that as a technician that even if you're not a directional trader, you still really want to know what the market's doing and what the areas of confluence are, where pullbacks are, where the big money is being put in on pullbacks because the truth is that all of the traders from Goldman Sachs, Morgan Stanley, and on and on and on, yada yada yada. They're looking at these levels. They know where these levels are. That's where they're getting in more so than not. And so there you have it. So with Elliott, which does utilize Fibonacci, and we're always looking for waves. And there are waves. This is great because you can apply this to. I don't care whether you're trading coffee, sugar, the Russell 2000, the SPX index, cotton, the U.S. dollar, gold and silver. No matter what it is, there are waves in the markets. It's applicable to any commodity, any security, any future on any given time frame too. And the trick about this is that if you're looking for a level, or greater wave counts or greater degrees of synergy, shall I say, or clearer degrees of synergy in one time frame, you don't see it, you can back up and back out of it, and find, this clarity or whatever, because that leads me to another point, and that's to say, which is why you really always, if you're really, doing yourself justice and really looking at the technical aspects of the market, you've got to be looking at multiple time frames. 5, 15, at 60-minute, 120-minute, 240-minute daily and weekly time periods. At least, if you really want to see, the market on an intraday basis, you're going to be looking at the 15-minute, the 60-minute, the daily and the weekly, or you want to go 15, 60, 120, 240 in terms of time periods. Never just looking at one time period. That's just too limited. And people who say, well, I can't find the wave count. Well, just back out, go from a 5-minute, go to a 15-minute, go to a 60-minute, go to a 120 or a 240 or a daily or a weekly, and you will eventually see it, and which will give you, precisely where you are. Now, the problem with Elliott Wave is, and everybody knows this, and that's to say it is subjective. So there's, it's not an objective standard. It's more of a subjective standard, and that is to say that, people have their different opinions about it, about where you are in the wave count. And I've seen traders argue about this, till they're blue in the face. No, we're really in a third wave. We're at the end of the 3-wave. No, we're at the end of a 5-wave, et cetera, et cetera, et cetera. But anyway, and that leads me to the next point, and that's to say there are only 3 rules, believe it or not, in Elliott Wave analysis. And that, again, I'll send you the link where this comes from. There are only 3 rules when it comes to interpreting Elliott Wave. There are many guidelines, but only 3 hard rules. These are unbreakable, and you can't break them. Otherwise, you won't have a wave count. The guidelines, on the other hand, are bendable and subject to interpretation. Furthermore, these rules only apply to a 5-wave impulse sequence, and the correction which are much more complicated are given more leeway when it comes to interpretation. So, Rule 1, Wave 2 cannot retrace more than 100% of Wave 1, which makes sense because you wouldn't begin to have a wave count. Wave 3 can never be the shortest. This can't be the shortest, and incidentally, there must be, 5 waves within the context of a wave 3 too, and that's a more advanced point. We'll get to that. Wave 4 can never overlap wave 1. So just a bit from a bit of a historical point, I'll go back to the beginning here. And, Elliott wave was developed by R.N. Elliott, popularized by Robert Prechter, who is also a CMT, charter market technician like myself. As a matter of fact, he really released the Bible on this, and it's at the bottom of this web page, and I'll show that. He just came out with a new book on socioeconomic theory as well, which looks like it's going to be very interesting. And this theory asserts that crowd behavior ebbs and flows in clear trends, and it does. I mean, it's interesting. I've noticed that I've sat in rooms where there are people behaving, in other words, and I'm listening to the amount of questions that are being asked in seminars. I started to realize, and these are waves too. I mean, because people get excited about certain issues or whatever when they're listening in a seminar, and they start asking questions. And so I began to analyze, the level of volume of the sound in terms of waves too. That's just kind of a tangential point. Anyway, Elliott identified a certain structure to price movements in the financial markets, and the article serves as a basic introduction to Elliott wave theory. A basic 5-wave impulse sequence and 3-wave corrective sequence are explained. And while Elliott wave theory gets much more complicated than this, a 5-3 combination will show you the basics. And here, these are, you can look at it in terms of grand supercycles or supercycles, cycles, primaries, intermediates, minors, minutes, minuets, and subminuets. And but I'll let you read that because, I mean, it's getting, we don't have a lot of time. But nevertheless, he goes on to say here, in reality, most chartists will use only 1 to 3 wave degrees on their charts. It can get quite complicated trying to apply 9 wave degrees and even just using labeling convention in the order provided. So the basic sequence to realize is this. I'm going to have to say there are 2 types of waves, impulse waves and corrective waves. Impulse waves move in the direction of the larger degree wave. When the larger degree wave is up, advancing waves are impulsive and declining waves are corrective. When the larger degree wave is down, impulse waves are down and corrective waves are up. Impulse waves are also called motif waves. So, and move in the bigger trend and larger degree wave. Corrective waves move against the larger degree wave. So, typically in the impulse waves, you do have 5 waves and 3 waves in the corrective waves. So 1, 3, and 5 are the impulse waves, and 2 and 4 are the corrective waves. Now, in 2 and 4, to take it to the next level of information, as I say, you can have a simple correction, which is just an ABC, or you can pattern typically, or in the next one in 4, you can have a complex correction, which goes, in a much more complex manner, if you will, can go on and on and on. You could have like an A wave with 5 waves, and then you can have a B wave with 3, or you can have a B wave with 7, and then you can have a C wave with 5 waves again. Typically, you do have a simple in 2 or a more corrective one in 4, more complex one in 4, or the reverse. You'll have a complex one in 2 and a simple one in 4. So it reverses like that. Or you'll just have simple. You can even have complex in both 2 and 4. So the chart above shows a 5-wave sequence. The entire wave is up as it moves from the lower left to the upper right. It's funny. I've heard some traders say, I don't care what's going on here. If I see a simple trend up from the lower left to the upper right, that's all I care about. Anyway, that's another story. But anyway, the entire wave is up as it moves from lower left to the upper right of the chart. Waves 1, 3, and 5 are impulse waves because they move with the trend. Waves 2 and 4 are corrected because they move against this bigger trend. And then here is, lower lows, and then here we have a down wave here. Basic corrective wave forms with 3 waves, typically A, B, and C. The chart below shows the ABC corrective sequence. Notice that waves A and C are impulse waves in green. This is because they are in the direction of the larger degree wave. The entire move is clearly down, which represents the larger degree wave. Waves A and C move with the larger degree wave, and they are therefore impulse waves. Wave B, on the other hand, moves against the larger degree wave and is corrective in red. And here we are, Combining a basic 5-wave impulse sequence with a basic 3-wave corrected sequence yields a complete Elliott wave sequence, which is a total of 8 waves because you've got your 5 waves and then you've got your 3 corrected patterns. Elliott, according to Elliott, this complete sequence is divided into 2 distant phases. The impulse phase and the corrective phase, and the ABC corrective phase represents the correction of the larger impulse phase. And now, similarly, we have another 8-wave pattern showing 2 larger degree waves 1 and 2, as well as the lesser degree waves within these larger degree waves. Waves 1, 2, 3, 4, 5 are 1 lesser degree than wave 1. By extension, wave 1 is 1 larger degree than waves 1, 2, 3, 4, 5, and waves ABC are 1 lesser degree than wave 2. So then we go on to fractal nature, and the market can always be analyzed in terms of fractals too, and it's a more advanced way of analyzing the market, but it can be done, and whereas you're looking for similar patterns, similar big patterns, that could be done at any time frame too. Again, if you can't find them on a 5-minute, you can back out to a 15, 30-minute, 60-minute, 120, 240, whatever. But I just want to make these points here in terms of the article, because we can go off on that tangent and get really deep into that, but we don't have time. But nevertheless, Elliott wave is fractal. This means that the wave structure for the grand supercycle is the same as for the minuet. No matter how big or how small the wave degree, impulse waves take on a 5-wave sequence, and corrective waves take on a 3-wave sequence. Any impulse wave subdivides into 5 smaller waves. Any corrective wave subdivides into 3 smaller waves. The charts below show the fractal nature of Elliott in action. So there's the bullish versus the bearish outlook. We've gone over the 3 rules, and here's that again to reiterate and review them. Wave 2 cannot retrace more than 100% of wave 1, as you can see here in this diagram. And wave 3 can never be the shortest of the 3 impulse waves, which you can see in this diagram as well. Wave 4 can never overlap wave 1. In other words, you can't. It does happen. It will blow the sequence out. If you blow your analysis out, you'll just have to start again or go on to a greater time period if that happens. If wave 4 does go down and violates wave 1. Here it almost did, but it didn't. So if it did, you'd say, no, this is just not not correct. I've got to back out in terms of time, go to a different time frame. So then there are the guidelines, which are debatable. There are 3 numerous guidelines, but this article will focus on the 3 key guidelines in contrast to rules. Guidelines should hold true most of the time, not necessarily all of the time. And guideline 1, when wave 3 is the longest impulse wave, wave 5 will approximately equal wave 1, and et cetera. Wave 2, the forms for wave 2 and 4 will alternate. That's what I was alluding to before in terms of being a wave 2 is a sharp correction, wave 4 will be a flat correction. And in addition to that, as I said before, if wave 2 is a simple, then wave 4 will be a complex correction, typically, and in the reverse as well. And after a 5-wave impulse advance, corrections ABC usually end in the area of the prior wave 4 low. So, you can read this on your own. And that paragraph. Even though this article just scratches the surface of Elliott wave theory, chartists can greatly improve their counting by applying the 3 rules and 3 guidelines listed. Elliott wave counts start with a process of elimination. Applying these rules for the first count attempt and then guidelines in the second, eliminating bogus counts, paves the way to a more accurate count. Even with the accurate counts, chartists will still need to reevaluate and adjust counts as new price information emerges. It's just the nature of the beast, and it's true. I've actually heard a lot of some traders, and here is the Bible here, Elliott Wave Principle by Robert Prechter, by Frost and Prechter. Great book if you want to get into this. Read it, from cover to finish, and it really, gets into it in a great way. I mean, he really, he took it to the next level. Anyway, so I thought it'd be fun also to for you guys to see, a level 3 exam from the Market Conditions Association. This is a test question that I wrote back in the fall of 2014 because I write questions for the Market Conditions Association. This was an actual exam question, and with the charts, on Elliott wave analysis. We're not testing Elliott wave anymore because the association's taking a new direction into more of a quantifiable direction, like the CFA. But for years, I was writing these questions for several years. But I just thought it'd be fun, kind of entertaining to, take a look at this as just another example of, what can be done with this. So let me just find this here. Well, here, first of all, this is the chart we're going to analyze. Here is the chart. This is a great Elliott wave chart. It's Chevron Corp. And here it is with nothing on it, just a plain chart. I took this from the market analyst software, and just with price on it. And as you can see, it goes from 1992 to 2013. And so I turned this into an exam question. And here, without that, students were, had to figure this out, and I had to say, here it is with the Fibonacci levels on here. And so I put the Fibonacci levels, for the exam, key, if you will. And starting, what I did, just to explain it briefly, or essentially explain it, I went from 1541 and laid the first Fibonacci level up to the high, the tip of the high. And then what I did is I created price points in terms of analysis to the upside, where price could go if it kept rallying from this high, because I wanted students to see, what the levels were, regarding those issues as well. So then what I did is I took another price point and laid in, from here, from the high of 125.890 to, what is the point of all this? The point of all this is to show you an example of how to analyze a chart using Fibonacci, and also to utilize, Elliott wave too in the process as well. That's the point. And to show you how to multi-layer Fibonacci levels, which is, and the point to all this again is to leading you to know about greater levels of synergy, where the market is, where areas of confluence, where are pivot points, where a pullback can occur, where a reversal can occur. So you can go out and analyze, the market on your own. And where did I draw this from? I drew it from Market Analyst software, and I drew this to create an exam question for the Market Technicians Association back in the fall of 2014. So this is the high, and so then I do the first level again. I draw it from the low to the high, and that gives you this level of the midpoint here. The midpoint here, if you will, 50%, a 70 point. And see this level right here, the way the market came up here and then pulled back to the midpoint, and then rallied up. So and then I do another level, and this shows if you did draw this from up here to here. This is the 61.8 point, and then I drew from this point, up to here to create these three lines in here. So I'm multi-layering, the Fibonacci levels, to find additional levels of confluence, because I could have just drawn it from here to here. But that's, I'm looking at that as being, too limited, because then we just end up with this, and this point, and this point. But what I wanted to do was create more points in here to see more layers of confluence in here. Why did the market do this? Why did it go from here to here, back to here, up into here, and pull back into here, and then go up into here? Well, here we have that multi-layered. To answer your questions furtherly, you've got, typically, so I ask students, where are the wave counts? Where are the wave counts? And so the wave counts were beginning 1. This is a nice beginning of a 1, 1541, to up to 2, 52.47. Back, that's the end of 1. Now we go to 2, which is 31.26. Not kind of a, I want to say, and you've got your A, B, C directional patterns here. How does it predict a trade entry and exit? I will get to that. What you want to do, this would be, if you saw this, if I'll get to that. So if you saw this whole pattern, I'll be getting to that. What you would do in terms of direction and how you would hypothesize about that. So let's say you're looking at this again. You're looking at this whole pattern. So you predict that you come to the conclusion this is 1 from 1541 to 5247. Then you come down here and you see that this is 2, 31.26. Your A is here at 37.94. Your B is 49.24. Your C, end of your C wave, is here at 31.26. Then I would say inside, this A wave, you've got 1, 2, 3. Then you've got 1, 2, 3 in your B wave. And then you could even, state that you've got in your C wave, you've got 1, 2, 3 in here, which I would say, that's simple. Now you've got your 2 here at 31.26, your 3 wave going up to 99.15, and see how that just fits so, handsomely right in there between your lowest, your high, and, you've got your 38.2 degree here. There are those that make fun of this and say this is Fibonacci, excuse me, but no. That's just right on the money right there. But nevertheless, then you've got, in your third wave, you've got your first wave here, 1, 2, and 3, 4, 5, which is nice. You've got your 5-wave pattern inside, your third wave right there. Now this gets more complicated because now you're pulling back, into your 4th wave degree, and so this is A, B, and C, I want to say, but there are those that would count this as 1, 2, 3, 4, 5, into the 4th wave. This is your 4th wave in here at 55.50. So then you're seeing this area of, confluence here, and now this is going up to the 5th wave in here. From 55.50 up to 125.89. So and here, again, you could argue that there's a 5-wave sequence from 1, 2, 3, 4, 5. But here, it's slightly shorter than wave 3, which is nice because wave 3 in here is, the longest wave again. And again, you've got 1, 2, 3, 4, 5. That could, and 5. But I'd say 1, 2, 3, 4, 5. And I'd rather use an ABC pattern in there. And here is the 5th wave. So how would you, if you wanted, that was part of the exam question too. Upon seeing all of this, how would you handle this? Would you look to short this, or would you look to, go long? And there's no right answer. Because as you know, traders are always going on both sides of the markets. So I would say, that one way of analyzing this, the first way is to say, okay, we've got a 5-wave sequence in here. We're looking to go long. What we'd ultimately like to do is wait for the market to pull back in here, because you do have these areas of confluence, which is right in here, because you've got, a multi-layers of Fibonacci levels here, and that, you've got, you've got your 3, 4, 5th wave. You're like at a 50% level of the 5th wave, so you'd be looking to go long in here you look to go long on a pullback in here. I mean, you'd love for it to see, pull back to this point to 100, and maybe you'd find, an inner bar, intraday bar, week bar into whatever time period you're interested in, and as soon as it breaks out above here, you're looking to go long. In the reverse, you would analyze this and say, and there, I don't know what that means, but thanks for the comment. But in the reverse, you'd go higher here, and as when it comes back here, you'd be looking to go long. In the reverse, other students were arguing that looking to go short because you've seen the high here. Now you're it needs to right. That's right, exactly. And so you'd be looking to go long in here, and so you're looking to go long. And again, there was no right answer. So if you're looking to go short, you'd think that this is this is the high in here. Then you're looking to go high. Yeah, exactly. 101 is low risk because you've got your bullish pattern here. No, this is going from Bob. This is going from 1992 to 2013. See this at the bottom here, the bottom, and so then you're looking to go long here, around 101. And then essentially what you're doing, or you could have argued that, in this exam question, that you could have, gone short in here. It's fading, going into an ABC correction. This is the beginning of the A down wave, if you will, whether it be simple or complex, that's another issue. And then you go back up into 125, and then you're looking to go short. And then you could have gained more points on this question by going from going long, and then you'd say, then you're imagining, because you're not seeing this, you're only seeing the blank chart on the exam. You're not seeing all of this. You're drawing this yourself within the under exam conditions. So it's not easy. And then you're what you're doing is from the high here, you gained extra points with a stop loss. That's exactly right. A stop loss below here, below 100, and exactly. And so you can, if you're going long, you'd be imagining that you've got your Fibonacci levels here at 3.82, 50%, and 61.8 on the next wave sequence. So you could argue, I'm going to go long here. I'm going to wait, here and start trailing stops at 38.2 or 50% or 61.8%. In here as well. Right, exactly. Yeah, and that's right, Bob. This is typically being used for mutual funds, long-term, people who are, going long with a lot of money. I mean, managing, Goldman Sachs, whatever, So and then the student would say that this is 61.8, 50%, 38.2, et cetera, and then can be long term or that's right, any time period. I mean, this is again, I want to emphasize this is an example that's being used under exam conditions for the Market Technicians Association from 1992 to 2013. But you come into the exam and that this is being used for any time period, and it could be used for a 5-minute chart, 15-minute chart. If you can see this, but I wanted to use this because this was a great example, a very clear example for people to work with quickly under exam conditions. So again, and as we speak, I mean, they're using this analysis. I mean, money managers, internationally or whatever. And there are a lot of people using Elliott Wave. It's become very popular in Asia, all across Asia in the past, I want to say 10 years. Of course, it's being used here in the United States. a lot of traders say that they don't like it, that they'd rather use this to determine, where the corrections are. They only use it. I've heard some guys and gals say that I want to use this for the ABC corrections. I know where the ABC corrections are now. It's too subjective to use it on the 5 wave counts. Here it's not. I mean, here it's really clear. I mean, again, you've got your first wave, second wave, third wave, fourth wave, fifth wave, and you can really analyze it, quite well. So having said all that, I could go on all day like this, but are there specific questions at this point? More than what you're asking? Just take some time for that. You see any, Tom? Why does it work? It works because, that's a great question. Why does it work? It works because, there's synergy out there. I mean, I know this is it's hard to accept this, and it was for me for a long time, because it comes down to human behavior and human emotion. People getting excited at the same points in time, just like, a great example, going on a trading floor and see why are traders getting excited about, yelling and screaming and pushing each other at a certain point, and getting excited about going long or going short. That's right. They're harmonics. That's a great point, Bob. They're harmonics that work in the markets. And, you have to, just like harmonics that work in the markets, this is a hard concept for some people to accept. I mean, what's so pleasing about looking at this? This is pleasing to the eye to look at this. Or again, it's the same way as you look at a great work of art. And why is the Mona Lisa so pleasing to look at? Because there's so much synergy in that painting. Or any great, work by Monet or a great piece of music by Mozart. There's so much synergy in that music. You're kind of like looking for, that beauty or that without sounding corny, you're looking for synergy in the market too, and and harmonics, in the market as well. And there are a lot of books that are written on harmonics in the market. William Delbert Gann got into that, and on many different levels, which we don't have time to get into here, but. That's taking it to another level. That's right, exactly. It's a measuring tool to determine the next levels. You're always asking yourself, where is the market going to go? As you know, I'm not telling you anything you don't know regarding that issue. I mean, you're always wondering where the market's going to go. Of course, the beauty about trading options, and especially with the road trip trade, is that you're not as concerned about that because it allows for pullbacks, allows for that leeway of pulling back and going higher and going lower, and gives you that time and that versatility to be able to adjust accordingly. But that isn't to say that you still don't want to know about this, because you're in the markets ultimately. And have that, and I would think would have that level of questioning in the four corners of your own mind. Where is it going? Why is it going this way? At this point, where we are in the markets, you could argue that perhaps, who knows? I mean, we could be going into an ABC correction. We don't have time to start looking at that here and now. We could look more at that on Thursday night. But going into an ABC correction, we probably we'll start to go in more of an ABC correction if we ever go below 30, 23.30 at this point, because then we'll probably go to 22.80 and perhaps even 22.60 and 40. Who knows? If we ever go below 30, but we all know that we're in a very bullish market here, and if it pulls back, it's probably going to keep going higher. But nevertheless, that's looking at the big picture. But we could keep going on and looking at more charts. But I thought, as a start here today, this is a good start, and combining Elliott wave and these Fibonacci types of analysis. Beginning with this Chevron Corp chart, looking at this, this beautiful chart, from 1992 to 2013, and there you have it. Are there any questions? Any more questions? Can you see any, Tom?
There's a couple. Can you see the chat?
I can't see it, actually. Let me see. Let me see. Yeah, now I can. Let's see.
Bob,
the bigger pattern is due to the sun. Well, that's the bigger pattern is due to the sun. Well, now you're Ted. You're opening a whole new can of worms. It's true. I mean, and that's what William Delbert Gann was all about, is planetary theory. But that's a whole different level of analysis that I do know a lot about. I've studied with several people, like Mike Jenkins, that is a real expert in that area. And gotten into that with him, and about planetary theory and analysis. And, I would say that, it's less of an influence than it was, 20 years ago with all the market manipulation that's going on, but it still is an influence and still does ultimately have, a definite, influence on human emotion. But that's a whole different discussion. Can you analyze SPY and see where it is heading? Well, I do that on Thursday nights, which I may move to Wednesday, but at this point, Thursday nights. Yeah, affects people in wars too. That is so true. There are those who are experts in that area that would argue that this current conflict in Korea has, is the outcome, of some sort of planetary movement as well. Which is very interesting. But now Mike Jenkins said that to me, that, when he was starting out in the markets, that, he was on the trading floor for several years and just couldn't figure out where it was going until he spoke to a trader from Goldman, and he says, "Okay, kid, I'll tell you the secret. It's the planets. Don't tell anybody." So people who laugh at it, there is a level of influence, but that's multi-layering Gann's theory on top of this, which I could get into, but I'm not going to do it today. But it's a whole discussion with it itself. Hey, Jim, is the computer-based training? Yeah, exactly. Do you know where I can buy a? That's great. A bridge, that's great. Yeah, it's so true. So true. Computers affected, but it seems to affect employment. That's so true. Anyway, I could go into more charts, but I think this is a great beginning and provides a basis. And I'll put up the link that I referred to before, and I'll provide these charts too. And I'll even put up this too as well. The where is it here? I could talk about that. Do we have more time, Tom?
Yeah, we still have a few more minutes.
Okay. Here we can talk about this. Let's see. I'm going to move this chat. Here's something else I have. I can begin to talk about this. Some common Elliott wave principle errors in our industry that the community should be aware of. Let's see, should I move this? Let's see, I'll put that here. Here's the first question. Issue in the current email thread, counting swings, ignoring internals. That's the problem with, I should mention to you, Advanced Get. That software, which was written by Tom Joseph. I used to go to his seminars years ago. I mean, it's a great. I mean, it used to be. I mean, there are those that that argue it's great. So it is great software on certain levels, but it doesn't show you the internal wave counts. In Elliott wave analysis. But and he sold that to eSignal, and the rest is history. I mean, in terms of where that is now. Anyway, the issue in the current email thread, counting swings, ignoring internals, is this a valid wave count? Is the question. I gotta move this. And no. Why isn't it? Because I mean, there's not five waves in the three. This is what occurs when only the swing is looked at as a wave. Here, wave 3 up from 2 down does not contain the required 5 waves. It only has waves 1, 2, and 3, no 4 and 5 or 3. Therefore, the count would have to be extended to become a valid complete wave 3. And here it is below. Like that. So it's really a wave 3 here. It's just, the chart and emails do not label wave 3 of 3. What happens late in the trend, you will not get run over. The error, however, was not the ending wave count. It is in the middle part of the wave, throwing you up. See, you can start analyzing these, and here you're thinking that you've got a full, 5 wave count. No, you've got 3 waves. See, that's just like it is here. Right here, it's really only 3. 1, 2, 1, 2, 3, 4, 5, 3 wave counts. See? And now you go to talking about wedges. Wedges is a whole different topic. Is this a valid termination diagonal triangle below? No. You've got 1, 2, 3, 4, 5. Watch. No, that's not. I mean, valid. Yes, it's valid, but it's not complete. Yes, all the internals are 3s, but the slope is wrong, so the probability of being right is very low. What do you mean by slope? Well, you see this? I mean, this is really, people were thinking it's 5, but it's 1, 2, 3. 3 here. There's the complete 3, 4, 5. All right, keep going here. Waves 1, 3, and 5 slope will fall forward, or at bottoms become more shallow. If 3 is parallel to the slope in wave 1, or were steeper, expect the diagonal triangle pattern to continue because 3 is more complex. Move 3 over, keep going. See that? And I want to say that a diagonal triangle is a real typical, pattern for 5 waves. In the context of the 1, 2, 3, 4, 5 wave pattern within Elliott wave analysis. Moving forward, if you have internals with building blocks repeating 5s going parabolic, it's not a wedge. So if wave 5 is going, on and on and on, it's not a wedge. But, you'll get you start seeing these patterns, the more you do this, it becomes second nature. And this is in a major, for Wall Street Firm's publication, but not a current analysis. However, it's still seen as a problem today. Triangles, here you have triangles. So, I mean, can I label this apparent contracting triangle wave A down, B up, C down, D up, E down? No, rule violation here. You have to stop doing this, guys. Every completed wave you define within a triangle must be its own completed 3 wave. No swing can be a standalone 5 wave pattern. Wave A down in this example has a clear impulsive 5 waves, so it has to be, it has to be this. 5 waves down, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, etc. Now, when you start seeing triangles like this, I mean, it's really powerful to see this stuff. You'll start developing an eye where you're looking for that E to go up and C to go down, like that. See that? If your supporting methods cannot favor the notion of a C wave down, you are not in a triangle. And I'll put this up on the website too. Next, Advanced Get. As I was saying before, this is an old advertisement they used to sell Advanced Get in Stocks and Commodities magazine. The wave counts aren't much better in the examples I see today. Advanced Get 3.0. They don't show the internals. And no box, is an expanded flat for wave 2 up. That's just not correct. The left line is where they end up, and 4 to the bottom 5 cannot make 5 waves to create a 5 wave. Move 4 over, then 5 down. Don't think that learning Advanced is a substitute for learning Elliott. Worse, if you do not know Elliott, how would you see that the air is above? It's good if you can, can count in hindsight. This is the second stage. The third is developing futures, et cetera, et cetera, et cetera. So develop it on your own. One more. This one would raise Armin Elliott himself. It's pretty funny. This is not correct. Wave 1, wave 2. That's not a wave 2. This would be the wave 2 in here. And 3 and 4. This is the triangle. Here's the 4 and ongoing. This is wrong. Again, I'll put this up on the site. From their wave 2 bottom up to wave 1 up, the internals clearly cannot be made into an impulse of 5 waves. That's just not enough. Wave 2 down overlaps the origin of 2. Credibility lost before they began. And if you're still reading, here's one more. Here's a gold weekly. Where can we use ABCD and triangles? Their wave 2 is not. It is not correct. Not sure if old Elliott Arn himself letters it through. So what is it in today's lingo? A down, B up, as C marked down. Marked down. Here's the picture again. To the bottom, forming a textbook perfect diagonal triangle. Connect the incidentally, you can read all about this again in Bob Prechter's book too, in great depth. Connect the slope within the impulse waves and the diagonal, and they clearly flatten out as well, which you can see. Slowly running out of time here. Let's see. And on the way up, 4 to 5 that's not correct. Back 4 over to the left and accept that 5 of 5 into the high was a diagonal triangle. Only then there is an impulsive swing diagonal that starts from the horizontal line that later marks their D wave high. What else is wrong? Degree area, 1, 2, 3, 4, 5, would end 1, not Roman numeral 1. Lots more wrong, but at this stage, who cares? One last comment. Don't put contracting triangles in second wave positions by themselves. They can be B positions within a continuing correction, but not alone. You see this? I mean, this is like, so there you have it. Where people go astray in this, in this analysis. So let's see from the chat here. Are there any further questions? You can keep going
Bob
deeper.
Bob asks, where would you learn about Elliott Wave? What are some good resources for learning it?
Yeah, Bob Prechter's book, Robert Prechter. Again, I'll send it in the link, but this is it right here. Let's see. No, I just lost it. No. This is a picture of the book right there. Frost and Prechter. I would recommend that book. And he wrote it several decades ago, but it's still the Bible today for many traders to learn from, modernly speaking. And that's the book I would recommend. And he has a website too. You could just Google him, and if you want to get into it more and more. I know I'm not. This isn't a solicitation, but years ago I used to subscribe to his service, which I learned from. And I used to. There's another guy who wrote a great book. His name is Steve Poser. And he's an executive at the New York Stock Exchange. He's been there for years. I used to go to the New York Stock Exchange and study with him. Study Elliott Wave out of his book, and his last name is spelled Poser, and he's on Amazon too. And he actually writes more in the way of actually being able to take trades from it, from Elliott Wave, as opposed to the overall analysis that Bob Prechter writes about. Bob is more of a he gets into a lot of theory, like he does I'm sure he does in his newest book called Socioeconomic Theory. But that's another good book written by Stephen Poser. Again, that's P as in Peter, O as in Oscar, S as in Sam, E as in Edward, R as in Robert, Poser. And those are two good resources to start to get into. And again, you should be and a great I'll put the link up too. Another great resource for Fibonacci analysis is Joe DiNapoli. I studied with him too, and he's a great. He took Fibonacci into advanced levels of Fibonacci analysis. He used to live in. I think he still does. Lives in Sarasota, in Florida. That's where I went to go study with him, and I know he moved to Thailand for a while, but I don't know. I don't know exactly where he is right now. But that's Joe DiNapoli. That's DINAPOLI. DiNapoli levels, advanced levels of Fibonacci analysis. That's another great book. And that's on Amazon too. DiNapoli levels. It's called. Let me see if I can just bring that right up. Might be able to. Let's see. Let's see. Yeah, I was just looking at that before, actually, trying to find, let's see. It's an example, but let's see. That's his website. Just Google them, DiNapoli levels, and there's a video. You could go there and see that too. Yeah. So those are two directions to go in for Elliott wave and Fibonacci. Are there any other questions? Let's see. Yeah, Larry Percivento. Definitely.
It was a good one from Peter.
Huh?
Did you see Peter's? He said, do the wave counts work for the same reason as the other synergies, like the 200 moving average and fib levels, because everybody is looking at them on the same charts?
Right. That's right. Pull back the 200-day moving average, different times. Same thing. That's the same thing. It works because of a lot of people have it on their charts to look for price action at the same level. That's right, exactly. This seems also to be the case for, that's exactly right, Fibonacci levels when they overlap in different time frames. That's exactly right. That's why it's so important to be looking at different time. You never just look at one time level. You got to be looking at more 4 time levels or even more. But typically 4. You don't want to get confused. I mean, you can go crazy with this stuff, looking at multi-layers of, that happens to a lot of traders too, looking at, 10 different indicators, as you know. I'm not saying you don't know, but, it's less is more too. But you've got to be looking at multi-time frames. Do the wave counts work for the same reason? Many people counting the same way. That's exactly right. That is the reason. Or are they rather a consequence of price action and reaction at support and resistance levels? Well, for both reasons. The wave counts work for the same reason. Many people counting in the same way. It's human emotion. People acting emotionally in the same way, going long or going short, selling at the same time, or are they rather a consequence of price action and reaction at support? Well, the price action is because of the human. Let's face it. I mean, human emotion. The argument could be made it's even in quantifiable. Because people are programming the trades a certain way, right? I mean, it's even in microscopic. It could be said in microscopic levels of quantifiable analysis, because Bob Prechter would argue that because of socioeconomic reasons, because of human emotion, even there. Larry Percivento, yeah, absolutely. Glenn Neely too. Yeah, absolutely.
All right, let's see.
So that brings us to about an hour. What's that? Yeah, I know.
Yeah, we're going to say we're about out of time. So really appreciate the insight to Elliott Wave. I'm sure it's new for a lot of people, and you've given some good resources and information about it. So really appreciate you coming on, Leslie.
Oh, my pleasure, Tom, and everybody else. Absolutely. Delighted to be here. So until next time.
Yep,
we can get into it more, everyone. Too. And see you next time, everyone.
All right. Bye-bye. Have a good weekend, everyone.
Yeah, have a great weekend, everyone. Take care.